If you're tired of getting trapped on fake breakouts, stopped out by one candle, or watching the market move without you, there's a reason. Institutions are hunting liquidity, your liquidity, and unless you understand their patterns, you'll always be one step behind. In this lesson, I'll show you exactly how liquidity sweeps and liquidity runs work, how institutions manipulate price, and how you can finally trade with them instead of against them. Before we begin, here's a quick disclaimer. This content is for educational purposes only and reflects personal opinions, not financial advice. Trading involves risk, and you should always consult a licensed financial professional before making investment decisions. With that being said, here's what you're going to learn in this video. The real meaning of liquidity in smart money trading. The difference between liquidity sweeps and liquidity runs. How institutions use these patterns to trap traders. How to apply multi-timeframe confirmation for higher accuracy entries. The advanced liquidity sweep trading strategy. The advanced liquidity run trading strategy. Real chart examples across different market scenarios. How these strategies can be used on all timeframes and in all financial markets. Before we start, if you enjoy clear, no-nonsense trading lessons like this one, make sure to like, subscribe to the channel, and turn on the notification bell so you don't miss the next strategy. Let's get started. When we talk about liquidity in smart money concepts, we're referring to price zones where a large amount of orders is sitting, waiting to be triggered. These are the levels where institutions can easily fill massive positions, because that's where the opposite orders exist. Around major highs, lows, trend lines, and especially areas with equal highs or equal lows, you'll always find clusters of stop losses, breakout orders, and pending orders, and institutions know exactly where they are. So what do? They intentionally drive the market toward those zones to collect that liquidity, fill their positions, and then move prices in the direction they actually intend. This is the reason you see bull traps above resistance, bear traps below support, and why so many traders get caught on the wrong side of the move. Before we break down the actual strategy, you need a solid understanding of two core concepts: buy-side liquidity and sell-side liquidity. Once you master these two, you'll stop falling for classic traps and start trading with the institutions instead of against them. Buy-side liquidity simply refers to the pool of buy-stop orders waiting above important highs, weekly highs, daily highs, previous session highs, or equal highs. Here's the logic. When traders take short positions, they protect those trades with buy stops placed above key swing highs. Those buy stops sit quietly until price taps into them, and smart money knows exactly where they are. So what do institutions do? They deliberately push price above those highs to trigger the buy stops, filling their own sell positions at the best possible price. Once those buy stops become market orders, institutions have the liquidity they need, then the real move begins in the opposite direction. This entire process is called a buy-side liquidity grab or liquidity hunt. In this chart, you can see a set of equal highs forming clear buy-side liquidity. Price sweeps above the old highs, activates the buy stops, and then drops sharply. Textbook buy-side liquidity collection. Sell-side liquidity works the same way, but in the opposite direction. Sell-side liquidity is made up of sell-stop orders resting below major lows, weekly lows, daily lows, or clear swing lows. When traders buy, they protect their positions with sell stops. Those stops accumulate underneath key lows, and institutions again take advantage of that. They drive the price down, sweep the lows, trigger the sell stops, and convert them into market orders. Once liquidity is collected, price reverses, because the institutions already got the sell-side liquidity they needed. Here, price breaks below previous lows, cleans the sell-side liquidity, and immediately reverses upward. Another perfect illustration of how smart money collects liquidity before pushing price in the real direction. Now that you know how buy-side and sell-side liquidity work, it's time to break down the two main techniques institutions use to collect that liquidity: liquidity sweeps and liquidity runs. Understanding these two concepts will help you recognize exactly what smart money is doing and position yourself to trade in the same direction. A liquidity sweep happens when price briefly moves beyond a key high or low for the sole purpose of collecting the liquidity resting there. The move is quick, intentional, and designed to trigger stop losses and breakout orders. Retail traders often jump in thinking a breakout is underway, but once the liquidity is captured, price snaps back in the opposite direction. That reversal is the signature of a liquidity sweep. Smart money takes the liquidity, reverses the price, and leaves trapped traders behind. A liquidity run looks similar at first, but the outcome is completely different. In a liquidity run, price targets the liquidity in the direction of the trend, takes it, and then continues moving with momentum instead of reversing. In an uptrend, price may sweep a previous high, trigger buy-side liquidity, and push into a new higher high. In a downtrend, price may break a previous low, clear sell-side liquidity, and continue dropping into fresh lows. Unlike a sweep, a liquidity run does not snap back. It uses the captured liquidity as fuel to extend the trend. This is how institutions build continuation moves, by harvesting liquidity and using it to drive price further in the same direction. Now that you understand the difference between a liquidity sweep and a liquidity run, let's look at a chart example that includes both. This will help you see how these concepts appear in real market conditions. First, notice how the market was moving inside a range. Price dipped below the support level, swept the liquidity sitting under that low, and immediately snapped back inside the range. That sweep provided the liquidity needed for institutions to push price out of the range and into a bullish move. Next, the market transitions into an uptrend. You can see price breaking a resistance level, which then turns into support. Price retraces, dips slightly below that new support, and closes back above it. This is a liquidity run. Price collects liquidity but continues with the trend instead of reversing. So when you look closely, you'll notice something important. Before every meaningful move, whether it's a breakout or a continuation, the market performs either a liquidity sweep or a liquidity run. This naturally leads to the next question: when should you expect a liquidity sweep? And when should you expect a liquidity run? To fully understand when the market will form a liquidity sweep or a liquidity run, you need to combine two foundational frameworks, Dow Theory and the Wyckoff method. Dow Theory divides the market into three phases. Uptrend, price creates higher highs and higher lows. Downtrend, price creates lower lows and lower highs. Range-bound market, price moves horizontally between support and resistance. Wyckoff helps us understand what institutions are doing inside those phases. Before an uptrend begins, the market usually enters an accumulation phase, forming a range. Right before the real upward move, Wyckoff observed a move called the spring, a quick spike below the range that shakes out early buyers. In modern smart money trading, we call this move a liquidity sweep because it grabs the liquidity below the range and then reverses sharply. Once that sweep is complete, price breaks out of the range and begins the uptrend. As price pushes higher, the trend is supported by liquidity runs, institutional continuation patterns. For example, price breaks above a resistance. That resistance becomes new support. Price pulls back, briefly dips below it, and then closes back above. This is a bullish liquidity run, and it provides the fuel needed for the uptrend to continue. You will see this pattern repeat at multiple levels as the structure continues to build higher highs and higher lows. Eventually, the uptrend slows and the market forms another range. Wyckoff called this the distribution phase, where institutions take profits and prepare for a reversal. Before the downtrend begins, Wyckoff identified a move called the upthrust, which is simply the opposite of the spring. In modern terms, this is another liquidity sweep, but this time, the sweep occurs above the range. This trap convinces buyers the market will continue rising, but institutions use their orders to sell into that buying pressure. After the sweep, price breaks down and the downtrend begins. During the bearish phase, liquidity runs continue appearing, but now in the opposite direction. Price breaks a support level, that level becomes resistance, a retracement occurs, price briefly moves above that level, then closes back below. This forms a bearish liquidity run, giving continuation to the downtrend. It happens repeatedly as the market continues to create lower highs and lower lows. So here's the simple but powerful takeaway. Liquidity sweeps appear during accumulation and distribution. They are institutional reversal patterns. Liquidity runs appear during uptrends and downtrends. They are institutional continuation patterns. Once you understand how Dow Theory and Wyckoff phases drive these liquidity behaviors, you can anticipate whether the next move is likely to reverse or continue, and trade with institutional confidence. Now let's move to liquidity runs. What they look like, how to identify them, and how to trade them with confidence. To trade liquidity runs effectively, you first need to understand trending market structure, because liquidity runs happen inside trends, not during ranges. An uptrend is simply a sequence of higher highs and higher lows. Think of it as climbing a staircase. Each step higher shows that buyers remain in control. The reason is straightforward. Demand is greater than supply, buyers are willing to accept higher prices, and sellers don't have enough pressure to stop the advance. In an uptrend, price moves in two phases. Impulsive move, a strong push upward where buyers dominate. Retracement move, a temporary pullback as traders take profits before the next impulsive move begins. The impulsive move defines the trend. The retracement resets the price and provides opportunities for institutions to accumulate more positions. Understanding this rhythm is essential because liquidity runs happen during these retracement phases. A downtrend is the exact opposite. Price forms lower highs and lower lows, showing that sellers are consistently overpowering buyers. It's like walking down an escalator that keeps pulling you lower. Every attempt to rise is weaker than the last. A downtrend also has two key movements: impulsive move, a strong drop driven by aggressive selling; retracement move, a temporary rally before sellers take back control. The impulsive move pushes the market downward. The retracement attracts liquidity, allowing institutions to reload short positions. Just like in an uptrend, liquidity runs appear during these retracement phases, helping fuel continuation. The technique is very straightforward. We use support and resistance to locate areas where liquidity runs are likely to form. Let's start with this chart example. The market is clearly in a downtrend, creating a series of impulsive moves downward, each followed by a retracement. At the beginning of each retracement, price temporarily finds support, so we mark that support level. Once price breaks that support, it turns into resistance. This is where we expect institutions to push price back into the level before continuing the trend. Now watch what happens. Price retraces, violates the resistance, and then immediately closes back below it. This is a perfect example of a liquidity run. A continuation pattern that tells us sellers have stepped back in and the downtrend is ready for the next impulsive move. And as you can see, after the liquidity run forms, the market continues downward exactly as expected. Now let's look at a liquidity run during an uptrend, so you can clearly recognize this continuation pattern in both market directions. On this chart, the market is trending upward, forming strong impulsive bullish legs followed by retracements. At the beginning of each retracement, price reacts to a resistance level, so we mark that resistance on the chart. Once price breaks above that resistance, the level turns into support, and this is the area where liquidity run is most likely to appear. Here's what happens next. Price retraces back into this new support, briefly breaks below the level, and then closes back above it. This behavior is a textbook bullish liquidity run. It shows that institutions temporarily pushed price below support to collect liquidity before driving the market higher. Immediately after the liquidity run forms, price continues upward, creating another impulsive move and extending the uptrend with new higher highs and higher lows. Now that you know how to identify liquidity runs, let's move to liquidity sweeps. As we explained earlier, liquidity sweeps appear during accumulation or distribution phases. In other words, during range-bound markets. Let's look at a clear example. Price is in an uptrend, forming higher highs and higher lows, but eventually the market stops trending. You can see that price tried to push higher twice and failed both times. This tells us buyers are losing strength and the market is entering a distribution phase. During this range, we simply draw the resistance zone at the top and the support zone at the bottom. Don't stress about whether the range is accumulation or distribution. All you need to do is mark the boundaries and wait for a clean liquidity sweep. Now look at what happens. Price breaks above the resistance zone and then closes back inside the range. This is a textbook institutional trap, a liquidity sweep designed to catch breakout traders on the wrong side. Right after the sweep, price reverses, and as you can see, the market moves downward exactly as expected. This is the power of understanding liquidity behavior inside ranges. You don't chase breakouts, you wait for sweeps. Now that you understand how institutions use liquidity sweeps and liquidity runs, let's apply everything on a real market example. This is the US dollar Japanese yen 5-minute chart. As you can see, the market is clearly trending down, forming a sequence of impulsive moves and retracement moves. Here is the first impulsive move, followed by a retracement, another impulsive move, another retracement, and then a new impulsive wave. Once we draw this support level, which later turns into resistance, everything becomes clear. Price retraces back, breaks above the new resistance, and then closes back below it. This is a textbook liquidity run. Institutions grab liquidity above the level, then push price downward into another impulsive move. After that impulsive drop, price begins retracing again. We mark the new support level and wait. Look at what happens. Price breaks below the level, retraces back up, breaks above it, and then closes back below it. This is another liquidity run, clear confirmation that institutions are still selling. 2 consecutive liquidity runs during a downtrend is a strong, smart money signature. It tells us exactly where institutions entered, and it tells us that we should follow them. The higher time frame for the 5-minute chart is the 30-minute. Let's take a look. The market is clearly trending down on the 30-minute chart and price is sitting at a support area. But notice something important. There is no strong resistance rejection. Instead, the last candle is a bearish doji showing selling pressure. This means the downtrend still has room to continue, which supports our trade idea on the lower time frame. Taking the trade on the 5-minute chart. Now, let's return to the 5-minute chart to finalize the trade setup. We place our entry at the close of the candle that formed the second liquidity run. Stop loss goes just above the liquidity run. The target is twice the risk. Look at what happened next. Price moved exactly in our direction and hit the target perfectly. This is the power of combining market structure, liquidity runs, higher time frame confirmation, smart money logic. When all the pieces align, trades become much clearer and more confident. Let's look at another example. This is the British pound US dollar 5-minute chart, and the market is clearly trending upward, showing that buyers are firmly in control. We have a clean sequence of impulsive bullish moves, one impulsive move, another impulsive move, and another strong impulsive leg pushing the trend higher. Here, a resistance level was broken aggressively, and that same level turned into support. Now look at what happened next. After the impulsive move, price retraced back, broke below the support, and then closed back above it. This is a textbook bullish liquidity run, perfectly aligned with the uptrend. This type of setup is one of the best ways to join a trending market with institutional confirmation. Now let's check the higher time frame, the 30-minute chart. On the 30-minute time frame, the market is ranging between a well-defined support zone and a resistance zone. At the support zone, you can clearly see a liquidity sweep, which signals bullish intention and suggests price may continue rising toward the resistance. This aligns perfectly with our bullish setup on the 5-minute chart, giving us a solid multi-timeframe confirmation. Now let's return to the 5-minute chart to enter the trade. We place our entry at the close of the doji that formed the liquidity run. Stop loss goes below the liquidity run. The target is always twice the risk. Look at what happened next. Price continued upward and reached the target exactly as expected. Another perfect example of how liquidity runs reveal institutional continuation in the direction of the trend. Now let's move to the second strategy, the liquidity sweep trading setup. Here we're looking at the Australian dollar, Canadian dollar 5-minute chart. As you can see, the market was trending down, but eventually it stopped making new lows and began moving sideways. This is an accumulation phase. Price hits this support level and reverses. It hits the same level a second time and reverses again, but on the third touch, something important happens. Price breaks below the support, triggers the liquidity sitting underneath it, and then closes back above the level. This is a clean liquidity sweep. This is exactly what Wyckoff called the spring, a false breakout designed to trap sellers before reversing upward. In modern trading, we call it what it is, a liquidity sweep engineered by institutions. This gives us a high probability trading opportunity. Now, let's move to the higher time frame to confirm the idea. On the 30-minute chart, the market was trending up and then began ranging. You can clearly see price rejecting the support zone, which suggests buyers are defending that level and the market likely wants to move higher toward the resistance zone again. This supports our bullish trade idea on the 5-minute chart. Now we return to the 5-minute chart to execute the setup. Entry, at the close of the candle that formed the liquidity sweep. Stop loss, placed below the sweep. Target, the next resistance level. Look at what happened next. Price moved upward immediately and hit the resistance level, reaching our target exactly as expected. Another clean example of how liquidity sweeps reveal institutional reversal zones with high precision. Here we have the New Zealand dollar, US dollar 15-minute chart. As you can see, the market was trending upward. Then it stopped making new highs and began moving in a range. Price hit this level twice and reversed, forming a clear resistance zone. It hits it again and reverses a third time, confirming that the uptrend has lost momentum and the market is entering a distribution phase. Now look at what happens next. Price goes back to the resistance level, breaks above it, triggers the liquidity sitting above the highs, and then closes back below the level. This is a textbook liquidity sweep, what Wyckoff called the upthrust. This tells us that institutions trapped buyers above the resistance and the next move is likely to be down. Before taking the trade, we check the higher time frame. For the 15-minute chart, the higher time frame is the 1-hour chart. On the hourly chart, we see the exact same reaction. Price reached the same resistance zone, swept liquidity, was rejected, and started moving downward. This higher timeframe rejection confirms that institutions are defending the resistance, which fully supports our trade idea on the 15-minute timeframe. Now we return to the 15-minute chart to execute the trade. Entry: at the close of the candle that created the liquidity sweep. Stop loss: above the sweep area. Target: the next support level. Look at what happened next. Price dropped strongly and moved straight to the target, exactly as expected after a clean liquidity sweep in a distribution phase. Another perfect example of how institutions use liquidity traps to reverse the market. As mentioned earlier, liquidity sweeps appear on all timeframes, from the 1-minute chart all the way to the daily and even the weekly chart. These patterns occur frequently, and traders can use them across every financial market, including Forex, stocks, commodities, indices, futures, and crypto. Now that you understand how liquidity sweeps and liquidity runs reveal institutional intentions, you're no longer trading blindly. You can clearly see where traps form, where reversals begin, and where trends are likely to continue. If you got value from this lesson, make sure to like the video, subscribe to the channel, and turn on the notification bell so you don't miss the next strategy. Thanks for watching, trade smart, and I'll see you in the next video.